Hey everyone, and welcome to episode 1.3 in the Investing for Beginners course. Today, we're going to learn more about the market as a whole, the economy, and the subtle differences between them. Let's get started. We constantly hear terms like the New York Stock Exchange compared to things like the economy. The problem is, we as beginners make vague assumptions about those words and often don't really get what they mean. How is the market different from the economy? Questions like these can be puzzling for people who aren't very familiar with business. The goal of this video is to clear up those confusions and provide clear distinctions between them. Now, why is this in an investing course? Well, the short answer is that markets, including stocks and other investment mechanisms, are tied to the nation's economy. When the country is in a recession, the markets of stocks will likely be hit as well. Everything you learn about trading and understanding stocks will be of no use if you don't understand the broader economy. So let's begin. Individual stocks of individual companies are traded on exchanges. The New York Stock Exchange is the largest stock exchange in the world, with other smaller exchanges like the Nasdaq, Shanghai Composite, and S&P 500 following up. Exchanges are simply places where shares, as the name implies, are exchanged. Next, we have indexes. These are basically collections of individual stocks that tell an investor how an industry or even a country is performing. Some famous examples are the Dow Jones Industrial Average, or S&P 500. The Dow contains 30 stocks that are regarded as the most important companies in the US, and sometimes those stocks are referred to as blue chips, since they're known to be very stable and reliable. Apple, Microsoft, 3M, Delta, and others are just a few of the Dow components. The S&P 500 similarly contains 500 US stocks. The point of these indexes is to provide, at a glance, the performance of a group of stocks. Worldwide, investors look at the Dow and S&P to gauge how the trading day went in the US. Similarly, there are indexes that contain only stocks from certain sectors of the market. So now that we established definitions for some of the terms used in markets, let's understand how the market is different from the economy. The stock market is simply a place where companies offer part of their equity to investors. The economy is a measure of the financial state of an entire country, not individual companies. In some ways, the two are tied together. In the crisis of 2008, the stock market went down like a landslide. At the same time, America's GDP, or gross domestic product, which is simply the total goods and services that were produced by the country, plunged into a recession. You can see from the two graphs that the GDP, an economic metric, went down at the same time as the Dow Jones, a market metric, in 2008. But what really happened in 2008 to affect both the economy and the market so much? We'll go more in depth in the history lessons unit, but I can give you a short overview right now. It started because banks and mortgage handling firms were making incredible profits from their businesses. They believed that they had solved the issue of risk by inventing complex securities called derivatives because they derived their value off of other securities, namely housing mortgages. Mortgages were low because of the housing bubble, so nearly everyone was buying homes. Banks took on incredible loads of debt, and eventually that led to default. As interest rates rose, people couldn't pay for their houses, and banks lost money. The derivatives, called mortgage-backed securities, were dramatically hurting the US. At the time, the Federal Reserve and the Treasury stepped in and provided the banks with free cash to free up some credit lines, which ultimately solved the majority of the crisis. This issue was so huge that it made 3 of the largest banks in the country either go bankrupt or get sold, caused the markets to fall over by 50%, and nearly caused the destruction of the entire US economy. The crisis of 2008 was just one example of how the economy and the markets are related. However, the stock market and the economy can also be considered as 2 separate entities. With day-to-day movements, the stock market is typically much more volatile than the overall economy. So to recap, we learned the various distinctions within the stock market with exchanges and indexes. Now I hope you understand the difference between the economy and the market. It's a difficult concept to understand, and it'll only come with time. Just remember, the economy judges the overall nation, while the market is just a combination of individual companies. But how does this affect investing itself? Let's say we were in 2008. You're about to make your first investment. At this point, the economy is fine. The stock market is boasting mammoth gains. You invest in a powerful bank that's unlikely to fall, Lehman Brothers. Suddenly, out of nowhere, the crisis hits. Before you know it, Lehman goes bankrupt, and you lose pretty much all of your money. This is an important lesson, because timing is an incredibly important thing when it comes to investing. The business cycle is a common theory that economists use to measure the growth of an economy. It's pretty simple. Businesses start out growing, hiring, making products, and selling them in massive orders. People have money, so they buy lots of goods. However, this buying causes the companies to raise the prices on their goods because it's selling so well. People don't buy as much, and businesses must start laying employees off. This sparks a recession in the overall economy. Then, things get better and until the businesses are at their peaks again. That's essentially what the business cycle is, an oscillating movement of business growth. This cycle might sound fictional, but it's real. We're right now on the rise from the rock bottom recession of 2008. Timing is important in investing because you don't want to buy stocks when the economy is at the very peak and overvalued, because soon the business cycle will start the downturn. The lesson is, if you want the best returns, find the undervalued stocks that have the potential to move up. Pay attention to the business cycle and the broader economy, and use that to make a prediction about whether stocks will rise or fall in the future. We'll get a lot further into the whole process of gauging the economy with Unit 7, Timing and Risk. But for now, just keep it in mind. I hope this video was informative and helpful for all of you budding investors. Be sure to like and subscribe, and keep an eye out for the next video. Next time, we'll have an overview of other investment mechanisms, like bonds, options, and mutual funds. Thanks for watching, and keep making money.